And it's an auspicious day because, of course, it's the first Friday of the month and it's non-farm payroll day. And joining us once again is Trader Nick. How are you, Nick?
I'm good, Johnny, and you said it best. A wild day for NFP. I mean, to be expected to have craziness, but today's moves are not necessarily completely expected.
Well, exactly. Very unusual. And we were just talking before we came on air. Difficult to explain some of the market reaction and indeed the dollar reaction, the oil reaction as well. Let's just drill down on the figures before I hand over to what you think. The number of jobs has surged much more than expected in the United States, and that certainly will be fueling expectations that interest rates could rise further. Employers added 336,000 jobs in September. That's almost double the 170,000 estimated. So guys, what do you make? Nick, first of all, what do you make of the market reaction? Because the market is up today. I don't understand, and I don't think anybody else does.
Well, Johnny, we have an interesting job here, a fun job sometimes, where we get kind of put on the hot seat and everybody wants to know, what is causing this move right now? And we've got some ideas. I think Ed has a few more than I do, but just to also reiterate what you said, that's a huge increase in employment change. Not to mention, across the border, Canada also had a major beat in terms of jobs numbers. A lot of jobs created in Canada, created in the U.S. In September. Very clear labor market strength. Now, this is coming off of, if you were to apply a 3-month average to the NFP number, it's been on the way down, but today I think it's an 8-month high in terms of jobs created. And this also, not to mention, you mentioned 171,000 was the forecast. Not to mention, on top of that, it's also, that was less than last month's number. We were expecting to see a continuation of that downward trend in job creation, which is what the Fed needs to happen. We've talked about it over and over on this podcast for inflation, the plateau, the ceiling that we've faced with inflation getting down into those mid 3.5% range. For the Fed to see that number to crack, to get closer to its 2% target, we needed a number today that was going to help out with that, and it does not seem we've got it, right? And you mentioned some very weird reactions. However, the initial reaction very much made sense to me. I mean, it was obviously a really hot job number, 336,000 jobs. That's huge. Now, we also had unemployment rate tick up, which I like to clarify this to newer listeners or to newer traders or investors. How can both of those two numbers go up? How can you have the unemployment rate percentage go up while the NFP, the employment change, went up as well? We had a ton of jobs created, and yet the unemployment rate went up. The reason, or the answer, the simplest way I can explain it is we're seeing participation rate in the United States increase. So a lot more people are out there looking for jobs. So it can actually exist where people are getting more jobs, but at the same time, we get a tick up in the unemployment rate. People saying, hey, I don't have a job, I'm looking for one, kind of thing. Anyways, to follow up on that, again, the initial reaction made sense. We saw dollar shoot to the moon, break out of resistance levels on the lower time frames, big time. We found what seems to have been a bottom, but following that, the dollar completely reversed those gains, and the inverse effect happened on the indices. We saw a massive jump on the NASDAQ. We saw a big jump on the S&P 500. And, it almost looks like we had a cool jobs numbers from the price action, but again, we don't. We have hot jobs numbers. So Ed, I want to bring you in on this because maybe I could just pass the baton, give you the hard question here. Why jobs data strong, and yet NASDAQ, S&P up, oil up? What do you see? Is there something you're seeing that we're not?
I think today was a fascinating day. When we saw the initial drop, everyone just focused on that headline number, 336,000. Rather impressive. When you add on the revisions for the past 2 months, it showed roughly over 450,000 plus jobs were added to the economy. That is pretty impressive. The report, however, was not completely as hawkish when you consider wage pressures came in a little bit softer than expected. This was, the initial reaction was pretty clear. We saw long-term U.S. yields surge to the highest levels since 2007. I think this is a report that really stunned most people on Wall Street. I think when you consider the concerns that we were going to start to see, much of corporate America has been signaling warning signs and have been providing, I think, an expectation that we were going to start to see hiring cool. That obviously didn't happen. I think one of the key things when you take a look, though, you always have to see how was the market positioned, and the market, for the most part, was anticipating that we're going to see a hot number was going to send Treasury yields higher, and that clearly happened. I think what a lot of people were then starting to realize was that even right now, when you take a look at Fed rate hike expectations, they really didn't change that much. And I think what we're starting to see is the market is becoming fairly convinced that, higher for longer just became higher, even much higher, and it's going to last even longer. And that is going to probably, for the most part, trigger, an economic slowdown that is going to do the Fed's work and bring inflation down. I think something is going to break given where rates are, and that's why we're starting to see. I think the markets, once the move was exhausted, people then started to realize that even if the Fed, even if we get a hot inflation report next week, it's probably one more rate hike, because policy has become and because the long end has really surged higher, yields, that is. This is going to be trouble for corporate America. So I think what we're going to see is refinancing debt, taking on more debt is going to be a big issue in 2024. So for me, next week is going to, people are going to focus on that inflation report, but I think, with the start of earnings season, we're going to hear from the big banks, and this is going to be what decides, the fate of the economy, the fate of the U.S. dollar. Is the consumer still resilient? Did the majority of the middle income households blow their excess savings? How bad are credit card delinquencies? What are debt levels becoming too uncomfortable? I think that's going to be the story that we're going to hear. And it seems, the last, few earnings reports, we've been surprised with how strong the consumer has remained. But I think this earnings season, I think, is where things, take a turn for the worse.